Hello, and welcome to the most comprehensive course on Japanese candlesticks. This course is based on a study that lasted 2.5 years to extract from millions and millions of historical data points the probabilities of Japanese candlestick patterns. The results have revealed more than surprising data, and after this course, you will have enough knowledge to predict, for a limited time, the price with 90% accuracy. Whether you already have a strategy or are just building one, imagine how the knowledge from this course can assist you. This study was conducted by IG Company. But to add more value to this course, we will also provide data from all reliable studies carried out to date, especially those that can benefit your trading. But before diving into the statistics behind candlesticks, let's start with the basics, how they work and why to this day. Japanese candlestick charts are the most widely used around the world. As you may have guessed, the name Japanese candlesticks was inspired by wax candles due to their great resemblance having a body and a wick. But why use Japanese candlesticks and not a regular line chart? The answer is simple: trading is based on analysis, and for analysis, having more data is always better. Japanese candlesticks allow us to have much more information about the price. If you're just starting out, the explanations might initially seem confusing. But by the end of the course, you'll be more familiar with Japanese candlesticks than wax candles themselves. So how do they work? When a new candle opens, it is usually white in color. When the price starts rising, the candle turns green. When the price drops within the same candle, its body decreases, leaving a thin trail called a wick to show us how far the price reached. If the price falls below the opening price, it automatically changes color to red. And the same process happens. As the price rises again, the wick shows us how far the price had dropped. So, a candlestick is based on 4 key points: the open, the close, the high, and the low. Here's a line chart. It only shows the close of each time frame. A line is drawn when a cycle closes, mainly serving to summarize a chart, but not for analysis. In contrast, when we convert it into a Japanese candlestick chart, we can see that the chart now provides much more information. The wicks tell us how far the price reached in each cycle, and the bodies show where the cycle opened and where it closed. Thanks to the ability to easily detect the open and close of the cycle, we can gauge how much strength the market has. A larger body represents greater strength in a certain direction. As we can see, thanks to the candlestick chart, it's easy to interpret, allowing us to spot patterns without difficult calculations or external tools. This is why professional traders prefer this type of chart. In just 4 minutes, you've caught up on what Japanese candlesticks are. Now the exciting part begins. Let's start the course. The goal of the study was to combat the 50% probability we have of predicting market movements. A vast amount of data was gathered, and a machine was set to start identifying patterns. The first step was identifying how many candlestick patterns existed. In total, approximately 100% Japanese candlestick patterns can be identified by the human eye. So we have 100 patterns to analyze. And we encountered 2 major problems. First, some patterns appear only once a year. And no matter how profitable a pattern is, you can't wait a whole year for it. The aim was to find patterns that were as frequent as possible for investing purposes. The second issue is that some patterns, despite their high frequency, provide no advantage in the market, as they align with the 50% probability, offering no edge. Of the 100 patterns, only 3 or 4 provide a significant advantage in the market. One of the most frequent patterns appears in 55% of Japanese candlesticks. If you've been in the markets for a while, you'll recognize some of the names: Hammer, Hanging Man, and Shooting Star. If you're a beginner and find the names hard to interpret, just think of a hammer. A candlestick that looks like a hammer can be either red or green. If we look at a green hammer, it appears 10% of the time on green charts. The red hammer appears 55% of the time on charts. The hanging man usually appears after a downtrend. According to textbooks and common analysis, it is said to be a reversal pattern. However, studies have shown the opposite. It's a continuation pattern. Essentially, when this pattern appears, there's a higher probability that the price will continue in the same direction. The green pattern appears 7.5%, while the red pattern appears 5% of the time. We also have another pattern called the shooting star, which is basically the reverse. The green shooting star appears 7.5% of the time, and the red one 5% of the time. In summary, 55% of the patterns repeat frequently and give us a positive result in forecasting the market, which we will review in more detail later. We've already discussed the hammer pattern. Hammers make up 25% of Japanese candlesticks, making it a very frequent pattern. If we look at the chart and see a green hammer, the analysis confirms that the green pattern has a 69% probability of breaking upwards and only 31% probability of breaking downwards. This already breaks the 55 chance, as we now have a 69% chance that the price will move in our favor. However, caution is needed here, as just changing the hammer's color drastically reduces the probabilities. We have a 60% probability of an upward break, and a 40% chance of a downward break. This means that if we want to maintain confidence in profitability, we should avoid entering with a red hammer. The hanging man is another pattern that appears 7.5% of the time. It's a frequent pattern and a continuation pattern, meaning that when it appears, the market is likely to continue in the direction of the trend. A green hanging man has a 68% probability of breaking upwards and a 32% probability of breaking downwards. Another study coincides with the same theory. The hanging man is a continuation pattern, not a reversal pattern as commonly believed. Be cautious with this. When the hanging man is red, the probabilities shift. There's a 57% chance of an upward break and a 42% chance of a downward break, which is very close to the 50/50th probability. Another widely accepted theory in trading is that the color of the pattern doesn't matter. Here we can see with probabilities that the color does indeed have a significant impact. In this case, the green pattern gives us an 11% higher probability in our favor than the red one. In trading, an 11% difference is substantial. That's why it's important to always rely on analysis and not opinions. The shooting star is a pattern that appears 7.5% of the time. The statistics aren't very promising. It only has a 45% chance of breaking upwards and a 55% chance of breaking downwards, which is very close to the odds of chance. However, everything changes when the shooting star is red. The probability of breaking upwards drops to 37%. While the chance of breaking downwards rises to 63%, making the color difference quite significant. Now, let's go a bit further. Let's study the green hammer pattern in more depth, as it has the highest probabilities. In a downtrend, we see a green hammer appear. The study shows that the average number of Japanese candles In favor, the movement is 5.5, meaning we can already expect that the market will break upwards and that we'll have 5.5 candles in our favor. 1, 2, 3, 4, and 5. Another very interesting measure the analysis has shown is that if we consider the past movement, 100% of the movement, we can predict the average extent to which the price will move. Similar to Fibonacci techniques, which we will cover in other courses. The downtrend forms the 100%, and we know that the average extent to which the price reaches with this pattern is up to 77% of the previous trend. Something quite interesting is that a lot of study has been done on that 100%. Whether the size is larger, smaller, more aggressive, or gentler, and all of this has shown that the probabilities do not vary with the previous trend, meaning it will always be an average of 77% of the movement in our favor. These are very interesting averages to calculate and take into account. Other interesting data is that everything must happen in the next candle, after the pattern. When we talk about breakouts, we refer to the price moving out of the hammer pattern zone. What does this mean? Well, if we outline the pattern zone, it would range from the closing of the candle to the lower wick. This whole area would be the pattern zone. The statistics tell us that the key is the next candle. If the next candle breaks that pattern, the probabilities hold. But imagine for a moment that the candle does not manage to break the pattern. What happens then? Well, the statistics tell us that only the first Japanese candle counts. If by the second Japanese candle the price still hasn't broken our zone, we revert to the probabilities of a 50/50th chance, as you can see. Everything is an average, but having this data can help you a lot. One thing to emphasize is that we are relying solely on the study of Japanese candlesticks. But the truth is, if you apply other techniques based on the knowledge from this course, the probabilities increase exponentially. In other words, if we encounter this pattern at a support level, the probabilities rise significantly. That's why we want you to have this foundation, because learning other techniques and applying them along with this one will greatly increase your chances of success. Now then, let's optimize the statistics to try to make the most of the study. The statistics tell us that by optimizing these patterns, we can achieve much higher hit rates by adding a few not-so-complex characteristics. And the secret lies in breaking the pattern's zone. If we enclose our pattern in a square from wick to wick, covering the entire pattern, hold on, because in the case of the hammer, if a breakout occurs upward from the pattern zone, and the price stays close to the breakout, the probabilities of the next market movement being bullish are 75%. And although predicting a move 75% of the time, even if it's a short move, is astronomical, you'll probably remind me that at the beginning of this course, I promised to predict the market 90% of the time. Well, get ready. Because if we apply the same square to the engulfing pattern, waiting for the price to break out and stay close to the breakout, our probability of the next move being bullish is 90.2%. And if you're looking for even higher percentages, wait for this. There's a rarely mentioned and little-known pattern called the advancing block. It's a green shooting star followed by two larger candles. And when this pattern breaks upward, the study shows a 93.7% chance that the market will surge upward. Yes, you heard right, a 93.7% chance that the price will surge upward. If you are going into binary options or a similar type of investment, you could practically end the course here. However, if you are going to use these techniques in Forex, futures, or any other financial vehicle where you not only have to predict direction, but also set a stop loss and a good profit target, then you'll be interested in what comes next. Here we have a decline and a green hammer appears. The data we know so far indicates that at this point, we have a 75% chance that the market will move upward, We also know that the market's retracement compared to the previous decline is 77%, which gives us a potential profit target. At first glance, everything points to a profitable strategy. But if we look closely, we'll realize that the 77% profit target is an average. And as the word suggests, it may happen or it may not. Therefore, we return to the 50% chance that the price will reach our profit target. And that's why, even though the probabilities of an upward movement are very high, we don't know if the rise will be 1% or 200%. In other words, the farther the target, the riskier it becomes. That's why it's important to emphasize that if you're using the pattern for short-term financial vehicles, it benefits you a lot because we've said that, on average, the price moves 5 candles in our direction. But if you're using these techniques in futures Forex, or any other asset where profitability depends on distance, it's essential to use a more advanced strategy to trade these patterns. But don't worry, we have some tips for you. Since we already know the average distance, the price can move and have high probabilities of predicting market direction. It's wise to move the stop loss as the price advances, to secure our profits. And if another strong pattern like a shooting star or an engulfing pattern appears against us, we should place the stop loss below that pattern, anticipating that the probabilities of the price turning against us are high. The most important takeaway from this course is the following: the most important patterns, the ones that truly give you statistical advantages beyond chance. Let's review this list. I recommend taking a screenshot to keep with you. If you remember all these patterns and take them into account when applying any technique, I'll be satisfied. As you can see, the eye icon represents how often the pattern appears. The 3 bars indicate the probability of success. And the 3 bars with an arrow show the probability of success with confirmation. Here we have the hammer, the famous hammer, which appears 25% of the time and has a 69% success rate, increasing to 75% with confirmation. If you remember, we draw a box around the figure, and the small breakout within that box would be our confirmation. As we can see, the probabilities increase. We also have the shooting star, which appears 12.5% of the time with a 63% success rate. And if we confirm the pattern, the probability rises to 69% in our favor. We also have the engulfing candle, which appears 12.5% of the time with a 74% success rate. And don't miss this: if we seek confirmation of this pattern, our success rate increases to 90.2%. We also have the hanging man, which in this case is a continuation pattern, essentially confirming a trend. It appears 12.5% of the time, with a 68% success rate, and if we confirm it, the rate increases to 71%. Lastly, the advancing block appears very rarely, only 4% of the time. But it has a statistical success rate of 78%. If we seek confirmation, our probability of predicting market direction increases to 93.7%. With this solid and impressive foundation, you can build any type of strategy, already stacking the odds in your favor that the price will move in your direction. And well, to wrap up the course, let's answer some frequently asked questions. How many candlestick patterns are there in total? The study has identified around 100 patterns that the eye can recognize, but the most profitable and frequent ones are the ones we've seen in this course, which is why this study is so important. I recommend staying away from all the patterns we've excluded from this course and focusing on the few we've covered here, as they are the only ones that yield positive results in terms of probabilities. Does it work for any market? It has been tested in different markets and time frames, and the determining factor is not the market, but investor behavior, which in this case is very similar across all markets. This is why the probabilities are consistent with different markets. The answer is yes, it works for any market and time frame. In lower time frames, we'll notice much more volume or movement than in a long-term chart. Are the examples valid for both upward and downward movements? Yes, the percentages are similar whether we take bullish or bearish trades using the candlestick patterns discussed in this course. Where should the stop loss be placed? According to the study, the best place to set a stop loss is just below the pattern. If the pattern is broken in the opposite direction, simply exit, limiting your losses. How old are Japanese candlesticks? They are approximately 200 years old, and they are still the most popular. What was the study's objective? The objective of the study was to combat chance and see if candlesticks really had patterns that gave us an advantage beyond 50%, which, as we've seen, turned out positive, with candlesticks having up to a 93% probability of predicting a direction for a limited time. Can I invest just with what I've learned? Yes, I'm sure you'll have more success than using nothing at all. But it's highly recommended to keep learning and combine Japanese candlesticks with other techniques, always testing first, achieving a positive result, and applying it in a safe environment. The mindset of an investor should always be to avoid losing money before making it, and to avoid losing money in investments. Statistics, not just opinions, are required. Which broker is recommended? The most recommended broker is one you trust, and very importantly, one that is regulated. Well, that's the end of the course. I hope you found it useful. If you want more content like this, just leave a like so I know this content is truly helpful to you. We also want to provide you with more information and studies. If you want to stay updated, just subscribe so we don't lose touch. I'll sign off here, wishing you much success, and see you in the next video.